Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome Dhruv Patel. He's the co-founder and CEO of Arch Lending, one of our new sponsors here at the Bitcoin Layer. Dhruv, great to have you on.
Thanks for having me on, Nick.
Now, as our sponsor, we want to make sure that we are communicating to people what exactly it is that you guys do. I want them to learn about your business. And then from the research side, I want to understand the idea of Bitcoin as collateral. And this is a direct derivative of layered money and how I teach the entire framework of money, which is that collateral and credit go hand in hand in a layered fashion. And so Bitcoin, in this example of Arch Lending's product, is a first layer money that allows the issuance of credit. We'll talk about where the credit comes from. Is it new money or existing money? We've talked about that. But first, why don't you just tell us where this company came from?
Yeah, absolutely. Hey everyone. Essentially, Arch Lending provides over collateralized loans against Bitcoin. Our target clients are both individuals as well as institutions. And when we talk about individuals, these are anywhere from people taking out $5,000 loans to individuals taking out $5 million and more for a single loan. On the institutional side, you can think of our clients as miners, hedge funds, investment funds, even some of the treasury companies that are publicly listed. And they all borrow for a variety of different reasons. Now, to step back, we started Arch Lending in the beginning of 2022. And our thesis at the time was a bit broader than just Bitcoin, but since we've really narrowed down on Bitcoin, but really there was all these asset classes broadly, Bitcoin being one of them, where banks and legacy financial institutions just wouldn't give credit towards when you looked at it as an asset base. And so we started the business to say, look, there are a variety of folks that own these types of assets. We should be there as a lender when it comes to them being able to access credit against them. And so Bitcoin is our core focus and was our first asset class that we looked into. And for the past just under 4 years, we've been doing these over collateralized loans to these target clients. And I can go into some of the differences that we have, and I'm sure we'll get into those. But that's really been at the core of Arch Lending.
All right. Now, let's start with the rates. I know that they're much higher than average lending rates or mortgage rates, for example, but give us a context of the over collateralization and the rate relationship. So, at what level does the rate come down, go up? Talk about that relationship first before maybe you get into the actual rate itself and why the rate is there relative to other parts of the lending market.
Yeah, absolutely. Just for context, as you pointed out, all of these loans are over collateralized. And now what that means is you'll see lenders quote an LTV, or what's known as a loan to value ratio. At Arch Lending, we go up to 60%, which means if you have $100,000 worth of Bitcoin, you can access up to $60,000 in cash against that. Now, one key difference in various lenders out here is this concept of rehypothecation. And all that means is what happens to your Bitcoin throughout the duration of your loan. So we explicitly have not and do not rehypothecate client Bitcoin. And what that means is it just sits in cold storage at our custodian partner. We use Anchorage Digital, federally chartered bank, but various people use other means of custody or rehypothecate. And now the reason I bring that up is because to answer your question on the relationship between the over collateralization ratio and the interest rates, we don't have any difference between whether you over collateralize it at our bare minimum or whether you heavily over collateralize it. And the reason being, we're not earning any money on your Bitcoin. Typically, when you see rates go down with more Bitcoin that you deposit, it's because the lender is rehypothecating, and that gives them the chance to earn more because you've given them more of your Bitcoin, and they can pass some of that earnings to you in the form of a reduced interest rate. So that at a high level is sort of how I think about that relationship. One way to think from the borrower side, you might think, look, I'm giving you more Bitcoin. The chance of me getting margin called or something is less. But that's sort of not how the industry works right now with respect to the capital side. And I know we'll go into where the money comes from to fund these sorts of loans. But that's how the relationship between collateralization and interest rates work. Now, to address the question of rates, look, I think rates are like higher than I would like, and in general, what people might perceive. There's a few different things. One is we were in a zero interest rate environment for a long time. So even right now, the floor of the federal funds rate is between 4.25 and 4.5. And it seems like this will come down over the coming months and maybe through the course of the year. But at least that's a baseline. Now, when you think about mortgages are a spread on top of that. And when you think about Bitcoin as collateral, for all of us that are in this space, right, we know it's pristine collateral. You can sell it 24/7. It's liquid, mark to market, and there's a huge amount of liquidity in the asset class. But when you step back, we and all the others in the space are non-bank lenders. And what that means is really we need other sources of capital to be able to provide these loans. So Arch has raised a CLO facility, which is just a fancy way of saying we've raised debt from the likes of Galaxy Digital and other large financial institutions to be able to provide these types of loans. Now, the cheapest forms of capital are the banks and the insurance players, the pension funds. They have not got comfortable with this as an asset class yet, but I imagine as they sort to enter the space and provide capital to players like us, we will see rates come down. And we've seen this in throughout the last few years where when we started interest rates were closer to 15%. Now we're lending at the lowest at 10%. And so I imagine we'll be getting into the single digits soon where most people expect it to go.
Excellent. There's a lot there's a lot to unpack there for the fixed income people out there because you mentioned CLO facility and being a non-lender. I want to explain that to the audience for a second. We're talking about not credit issuance here and an increase in the amount of bank deposits in the system when Arch Lending does an over collateralized loan against Bitcoin. They are drawing on basically a facility of lenders that have raised capital from a variety of sources, and that capital comes into facility, and through that, Arch can lend out into the market. So it's existing capital, not new fresh credit that's being issued. That's important. The rates down to as low as 10% is great, and they're heading lower on the reference rate side. So hopefully, the entire risk curve falls in rates and people can access Bitcoin loans at a lower rate than 10%. My question to you is walk us through the average six-figure loan that's over collateralized in Bitcoin. Uh, you can speak in general terms. What type of borrowers are in that six figure? I'm probably ask you the seven figure question in a minute, but let's start with that six figure loan. What is it a person or institution in that amount, and what are they borrowing for? If you have any insight into that, what and who are you competing with? What other types of loans? Is it bank statement loans? Is it other sort of home equity loan? What type of loan are you competing with in that range so that people can get a better understanding of maybe not your original target customer, but the demand shows you where to move the business?
Yeah, absolutely. And just one thing that came to mind, Nick, on the rates, it really the other piece you have to think of is Bitcoin as an asset class has been, its CAGR is over 50% historically, and even if you give it a slight discount going forward, that is still better than the interest rate, right? So if your alternative was selling Bitcoin, borrowing is a sort of much better solution, even at call it 10, 12, 15% interest rate, what have you. But then going back to your question that you just asked, the six-figure loans, who are these folks and what are they using it for? And then I'll go and touch on who we're really what types of loans we're competing against. So these are largely individuals. For us, our average individual loan size is closer to 200K or maybe just north of that. And so these are folks throughout the US. We have clients in most states, and it's not really concentrated in New York or California. I would say the age demographic is also interesting, where many of these individuals are 40 plus and they've been holding Bitcoin for some time or have been diversifying into Bitcoin. And so I think at the six-figure range, you're really looking at, okay, you have two Bitcoin or north of that that you want to borrow against. Now, what are the use cases that we see? We see three common use cases. One is to make other investments. So people are borrowing to maybe put a down payment on a house or to buy real estate. Some individuals are borrowing to acquire businesses, or they run their own businesses that don't have external funding. And so borrowing against Bitcoin is a way for them to cover any shortfalls or sort of pursue any expansions that they want. Now, the second is to handle any expenses or to make larger purchases. We've seen everything from medical bills or tax bills come up. We've seen people buy engagement rings, sports cars, things of that sort that they, have been eyeing to purchase. And here's a way for them to do that. And the last is for general lifestyle needs. I would say there's a segment of individuals that are maybe don't have a traditional W-2, maybe are retired, but they own Bitcoin and they don't want to sell it. Here's a way for them to sort of continue to finance the lifestyle that they want to live while maintaining their assets. And so those are the rough categories of reasons that people borrow, especially at the six-figure range. And then in terms of the types of loans that we compete against, I think there's a few. People can get personal loans. Typically, those cap out at a certain size. The second is it depends on the nature of the individual. If you have assets outside of Bitcoin, maybe a home equity line of credit or drawing against other assets, borrowing against your stock portfolio and things is available. I would say that the differences that we see are one, we move extremely quick. And so almost everyone gets funding same day. And then the second is there's no credit check. This doesn't go on your credit report. And it's a very simple and easy transaction, which is why many people sort of come to this avenue.
That's great. Now, I find it very interesting that you mentioned business expenses or even expanding the business as one of the reasons that the loan is. And then, of course, lifestyle choices, changes, the engagement ring use cases. It's interesting because it also has to do with business expansion in that family formation and business expansion are both ways that aggregate demand grows across the economy because we live in a credit system and the growth of business and business loans and family formation in is has a strong relationship to first time home buyers, which are 100% expansion of credit through the capital markets, mortgage backed securities. But the primary mechanism that before those loans get into mortgage backed securities is credit creation in addition to those small business loans. So these are use cases that are traditionally financed in the primary credit issuance market, meaning actual loan origination. But now Bitcoin is being monetized in this way. And when we use the word monetize about Bitcoin, it does mean so many things, but this is one of the ways that it is, and one of those definitions that is screaming out right now, which is that if you have Bitcoin, let's say you've held it for any material amount of time, those gains are unrealized. But when you take out a loan against it and turn it into cash, even though that cash isn't new, it was sitting in an investment portfolio that is now deployed. We hear about cash on the sidelines. Cash on the sidelines basically just means cash that's not in very risky assets. It's in low risk to moderately risky assets. It doesn't mean that that's cash that isn't invested. So this bridges the gap between cash on the sidelines, Bitcoin, and future credit issuance. So we think about Bitcoin as uh, actually fuel for future economic growth as it gets monetized through this process. Do you have any thoughts there, Dhruv, about my thesis behind Bitcoin as collateral here?
Yeah, I think it makes sense, right? Like when you're saying cash on the sidelines, it's not just like cash under sofas, it's in treasuries or in some other asset that's lower on the risk curve. And um, credit is a really important part of any asset class. I would go so far as to say like debt markets legitimize an asset class, right? The goal is to like continue to hold and maintain your Bitcoin, but we live in a fiat denominated world right now with people having expenses, rent, things that come up. And so being able to borrow is really powerful in that it continues to allow you to hold on to your Bitcoin and benefit from that appreciation. So I think credit in and of itself sometimes gets a negative lens when you think about debt. Now, there's good debt and bad debt. If you're revolving credit cards, maybe that's not the greatest, but debt in this scenario where it allows you to continue to own an appreciating asset, I think is a good thing.
What about systematic trading? Do you have users that you're aware of that are borrowing and investing right back into Bitcoin or Bitcoin products? So, like a pure leverage user, and the audience might ask, why would the person do that? Well, if the borrow is 10 and the expected return is 30, 40, or 50, that's an arbitrage opportunity. So, do you have any
Absolutely.
users like that?
Absolutely. I forgot to mention that, but that is a use case that we see from a fair amount of users as well for the same exact rationale that you just outlined, which is look, like you're borrowing at 10%, you expect Bitcoin to continue to compound at 30 plus percent. That is a very sort of profitable, if you will, trade to put on.
Right. And I realize as I'm asking the question that it might sound like I'm recommending this sort of activity. I'm definitely not. Once again, this is one of our new sponsors at TBL. So we just want to tell the audience that Arch is a sponsor of TBL, and we want to explain the product better to people so that they can understand it, explain the use cases. We don't advocate for any particular investment strategy or leverage strategy. And I think that that's important too, because as a global macro research shop, we're thinking about Bitcoin in the context of other asset classes, how it's moving in the short term and the long term. And that's what matters most to us, is teaching people about Bitcoin, its position in markets. And yes, is it going up or down is a huge part of what we do, but not advocating trades or advocating leverage. So I want to ask you now about, you mentioned differences. So were you talking about differences between Arch and other Bitcoin collateralized lenders? Did you already answer that question when you talked about the rehypothecation, which I think it's a very important differentiator for sure.
Yeah, so I was talking about those, like the differences between Arch Lending and other Bitcoin backed lenders. I think the few that stand out, one is the rehypothecation, which is a key thing. The second is white glove client services, which the Arch team is fully US based and easy to contact, whether it's over the phone, video call, message, email, what have you. And then I think the last is really a sort of like transparency measure where we segregate client collateral for loans above $100,000. We can share the Bitcoin wallet address with our clients on chain. They can see it 24/7 and really know that that's sort of proof that we don't rehypothecate. And so I think all of those things really go to help. And then the last is in our loan terms, we can go up to 2 years fixed loans, which is the longest on the market. And the real goal is at the end of those 2 years, you're able to just refinance and roll over into another 2 year term. And so effectively, people can borrow indefinitely by just continuing to roll their loans over. And it's a very private banking esque approach where the ultra wealthy that access private banks, there's this phrase buy, borrow, die. They just continually borrow. And we effectively want to allow Bitcoiners to do that as well.
Now, what part of your mission or drive is the idea that people don't want to sell, that Bitcoin is an asset class that has a lot of participants with a very long time horizon? Did that drive a big part of your business idea at the beginning? Is it a big part of what you guys do, or are you think, or is that just part of your target market is this very long term holder, and another is maybe more the leverage types, the traders, or people that want to finance a certain lifestyle?
Yeah, I would say it's more of the former, where really like the core thesis was that Bitcoin is a very important asset class, and now how do we continue to legitimize it? Credit is, one of the forefront ways to do so. And so, even when you look across these, Nick, people own homes now. HELOCs and stuff is a way for them to borrow without selling it. You see that in the same thing against gold, against stock portfolios. So really, it's almost reverse, where first you recognize, hey, Bitcoin is a very important asset class. There are at that point in time many people owning it, and that number has just continued to multiply with ETFs and more people getting exposure elsewhere. Now the question becomes, okay, people are owning this asset class, they want to own it for the long term. How can you solve some of the problems that they're going to face along the way, which is maybe needing access to cash against it, needing to finance other sort of use cases that we already talked about while continuing to hold the asset. And that's sort of how it came about.
I'm very curious about lending against or borrowing against stock portfolios. Is that can you describe your customer base that has perhaps taken out a loan against an equity portfolio in the past, in the recent past, and maybe paid that back, or wants to do the same thing but now with Bitcoin instead of the equity portfolio? What is the lending market like on that equity side? How do the rates compare?
Yeah, so I would say the rates are pretty similar. It's and on the equity side, it's not as standardized. It depends on which brokerage. Some brokerages may not offer this, but if you go to Schwab, Fidelity, you'll typically be able to borrow. It also varies based on what stock you're using, whether you're using the S&P or a single name stock. So there's a lot of variables, but at the high level, I'd say borrowing against Bitcoin is more seamless and if not the same rate, maybe slightly cheaper. In terms of how it works, though, it's very similar in that if you see any volatility in the asset, there's a few sort of things to keep in mind, and this holds across both. But I'll just speak for Bitcoin. So with Bitcoin, there's two things you need to be aware of: what happens when Bitcoin price increases, what happens when Bitcoin's price decreases. So when Bitcoin price decreases, there's different thresholds. But if you start at the loan to value 60%, if the price continues to drop and your loan to value hits 70%, you will receive a margin call where the lender asks you to deposit additional Bitcoin or pay down your loan partially. And if price continues to drop and the loan to value hits 80%, there could be a partial liquidation where some of your Bitcoin is sold to bring your loan back into good standing. Now, that same thing happens in stock based loans as well. And on the other side, when Bitcoin price increases, you can do one of two things with Arch lending. One is you can simply access more cash against it. The second is you can say, hey, look, price of Bitcoin has gone up. You don't need as much of my Bitcoin collateral anymore. Can you send some back? And so both of those are things that we do. But I think in terms of understanding it through the lens of borrowing against your stocks, those are like the parallels that I would point out.
All right, I found this aspect of the CLO facility very interesting. So, can you explain to me and our audience what do you mean by CLO facility? What is the transparency that you're trying to bring to the market?
Yeah, absolutely. So maybe I'll step back by saying, as I mentioned earlier, we're a non-bank lender, and so that poses the question of how do we get the capital to provide the loans that we're giving here. So you see a few different ways that people approach it and have approached it in the past, and then I'll talk about why we went down the route of the CLO, which at the time I believe was that we were the only player that had announced such a thing, and what it's really allowed us to do with respect to transparency as well as just growing the business. So the first is if we go back to how do people finance themselves, right? You'll see people that have earned products or ways that people can earn yield. Now this is effectively mimicking a bank where they're taking in dollar deposits from retail or other types of avenues and then lending that out to provide the and using that to provide the capital of the loans. That's one avenue. What we've seen is it's really hard to one see real scale with that type of a product, but also match durations. People don't want to give you their money locked up for a year, but people want loans for a year or longer, and so it naturally poses some risk as the lender. Another avenue that people do is they'll take client Bitcoin and then transfer it to a third party who will then give them a loan against that Bitcoin. If that makes sense, it's effectively back to backing the loan with some other party. And then what we've done is squarely on the other side, where we went through the sort of process of standing up a CLO facility. Now, what this is it's a sort of financing vehicle where you can have Arch Lending is there, and we have a variety of different financial institutions on the other side that are providing us capital and earning a sort of fixed income like return. And so the public one that we've listed and we started this with was Galaxy Digital. They're a publicly listed crypto company, and very well reputed, but we are able to raise capital into that facility, and then use that to lend to do our Bitcoin backed loans. And when we charge an interest rate, a portion of that goes back to these lenders, and that's the sort of yield that they're earning. Now, so for us to continue scaling, it's simply increasing the size of that facility and having new lenders or Galaxy and others continue to provide more and more capital into this pool. And so a few things that does from us is one, it's very clear to anybody where our capital comes from. You don't have to guess whether we're rehypothecating or where the source of funds are, because we've been very public about this. But second is it sets us up very nicely to scale, because we just need to continue to tap into our lender network and increase the size of this one facility that we have.
Dhruv Patel, co founder and CEO of Arch Lending, thanks for coming on the show today and explaining your company and also explaining the market for Bitcoin collateralized lending amidst the layered money thesis. Why don't you tell people where they can go to find out more about your company?
Absolutely. You can go to archlending.com, or you can find us on Twitter at archlending, as well as once you go to our website, there's plenty of avenues to message us or give us a call. And I think those are the best resources.
Great. We'll catch you guys next time.
Awesome. Thank you, Nick.